Hello students, today I would like to welcome you all to this video. In this video, we are going to learn about depreciation. So let's start learning the depreciation with the definition. In simple words, the depreciation is a systematic way of recording the reduction in the value of an asset. So depreciation in simple words is just to record the reduction in the value of an asset. The value reduction can be done with the passage of time, with the usage, or by any other wear and tear, technological advancements. So any sort of reason can create a reduction in the value of an asset. So the depreciation is the way to record that. So now, how many ways do we have to record the depreciation? We have different methods. So the methods that we have, the first one is straight line method. The straight line method, in which we calculate the depreciation by two ways. So the first way is, if we have the cost of an asset and we deduct the value of any residual value, mean the scrap value is the value that we have after his useful life. Like if we have an asset that has a useful life of 4 years, so after 4 years, how much will be the value of this asset, like means the scrap value or the residual value. So we'll divide this number with the useful life of the asset. So we can calculate the straight line depreciation with the help of this formula, in which we have cost and residual value, mean the scrap value. So we have to deduct the scrap value from the cost, and then we will divide the useful life of the asset to get the number, to get the figure of the depreciation. So that's the first way, the first formula that we can calculate the depreciation. In the straight line method, the second way is, we will have the cost value and we can get the depreciation by multiplying with the depreciation percentage. So cost multiply the depreciation percentage will give us the depreciation value. So this can be a way to calculate the depreciation of an asset. We will have a look on this. Let's see, for example, if we have an asset with the cost value of 50,000 and we have a useful life of this asset, means that we will use this asset for 4 years, and after that we will scrap this asset at the value of, for example, $10,000. So how much will be the depreciation? So because as we have the useful life of an asset and residual value, so it means we will go with this formula and we will get the figure of depreciation by deducting the scrap value from the cost value and divide this with the useful life, that will be the 4 years. So 50,000 less 10,000 will give me the number of 40,000. So 40,000 divided by 4 will give me the answer. Depreciation figure is 10,000. So that will be the depreciation value of every year. So means every year the asset is going to be reduced by this much amount of number. Now the second way is, for example, if the same asset we have the cost value of 50,000 and it says in the question to calculate depreciation using straight line method by applying 20% rate of depreciation. So the depreciation will be the cost value of an asset, that is 50,000, by multiplying this by 20%, that is the rate of depreciation. So we will get the answer of depreciation, that will be 10,000. So this is another way of calculating the depreciation. So the next thing that we need to know about this method, the straight line method, that every year this depreciation will remain same. So if this one is for the year 1, so in year 2 we'll follow the same method, means the cost multiplying the depreciation percentage. As we know that the cost will not going to be changed over the year, so as it will remain same, it will be applying by the same depreciation percentage, will give us the same amount of depreciation every year. So because the depreciation amount is not going to be changed, that's why this method is called straight line method. So once we calculated the depreciation, it will remain same over the years. Now the second method that we have for depreciation is called reducing balance method. The old name of this method is called diminishing balance method. So in this method we usually get the depreciation percentage. So it says in the question, like, so we have an asset of, I'm going to use the same value, so the cost value of an asset is $50,000, and it will says in the question to calculate depreciation by using 20% rate under reducing balance method. So with the reducing balance method, in year 1 we'll calculate the depreciation by multiplying the cost value with the depreciation percentage, that is 20%, will give us the depreciation value of 10,000. And in year 2, here the change will come up. So with the reducing balance method, we have to deduct the previous year depreciation, the depreciation that we have calculated before. So we'll deduct this depreciation from the cost value, and then we will apply this percentage. So now the 50,000 less 10,000 multiplying 20% will give us the number of 8,000. So I will show this to you in the calculator as well. So here we have 50,000 less 10,000, 40,000, and then we will go with 20 divided by 100, means the 20% will give us the value of 8,000. So now in year 3, so the cost will remain same, 50,000, but now the total depreciation that we already reduced, that we already charged against this asset is 18,000, 10,000 in year 1 and 8,000 in year 2. So the total depreciation will be 18,000. So we'll deduct the 18,000 from this number to get net book value. So assets cost minus depreciation will give us net book value. So net book value multiplied by 20% will give me the depreciation of third year. So I will do like this: 50,000 less 18,000 multiplying by, so 32,000 multiplied by 20 divided by 100 will give me the answer of 6,400. So 6,400 will be the depreciation of the next year. As we can see that the depreciation value is going down every year. So in the first year it was 10,000, second year is 8,000, now is 6,400. So the balance is reducing each and every year. This is the main this is the name of the method, reducing balance method. It reduces the value of depreciation every year. Now the third method that we have is called revaluation method. In this method, how we do the calculate, so it will say in the question that we have a cost value of an asset is 50,000. So it says that after year 1 the market value of this asset became 38,000. So calculate the depreciation using revaluation method. So in revaluation method we have to compare the cost value with the market value of an asset. So any change in the market value means the reduction in the market value as compared to the cost will be our depreciation. So the depreciation will be 50,000 mean the cost value less the market value. So that's give me the number of 12,000. So that will be the depreciation of year 1. So let's for example, if we have in year 2 the market value become 30,000. Now in year 2 depreciation will be, we are going to calculate this depreciation by comparing 38,000 with the 30,000. Here we have to remember that in this method we are not going to it's again the same as the reducing balance method, means we will go with the net book value. So the net book value will be the 50,000 less 12,000 means 38,000. So we'll compare this with the new market value, that is 30,000. So 38,000 less 30,000 will give me the number of 8,000. So that will be the depreciation of year 2. So we'll compare this 38,000 with the new market value to get the depreciation of the second year. So these are the main methods that we have in depreciation. For the depreciation, the first method that we have is called straight line method. So the straight line method we do in two ways. We have two ways to calculate the straight line method. The first one is by applying this formula, cost minus residual value divided by useful life of an asset, or they can give us the cost into the depreciation percentage, depreciation value. So we need to know that every year the calculated amount of depreciation will remain same, because the cost or the residual value or useful life does not change. So it will remain same every year, as we have seen here in this example. So in the reducing balance method is also called diminishing balance methods, in which the first year we calculate the depreciation by using the cost value and the depreciation percentage, but in the next year, from year 2, we'll calculate the depreciation by applying percentage on net book value, which means cost minus previous year depreciation, total previous year depreciation, and the value that we left over with, we will apply the percentage on that. So in the third year, the total depreciation that we already charged was 18,000. So that's why now the percentage applied on that 20% after reducing 18,000 from the cost value. In the third method, we have revaluation. So it's simple that we have to compare the cost value or the value with the market value of the asset. The next step The next thing that we have that we can have in the question is the T accounts of the different we have three T accounts. The first one will be our asset account, that can be any asset, furniture, machinery, motor vehicle, or anything. So that's the first account that we need to make in the question, the depreciation question. I will solve some question for you in the next video, so you can have a better idea how to attempt the questions from the depreciation. So in the asset account, as we know that assets comes up on the debit side, so we always has an opening balance of asset on debit side. So the amount, this one that we will have in this account, always remember, I always tell my student that this value in this account that we will record, all the value is the cost amount only. Means we only record the cost amount in this T account. So if we have an opening balance of asset previously owned, so we'll write down here with the value of cost value. The next thing, if we purchase any asset during the year, so we paid by check or cash for that asset, so we'll write the name accordingly, like bank or cash account, and we'll write down the amount here. That's again the same amount, means the cost amount only. So we'll write down the cost, how much we paid for the new asset. The third entry that we can have in this account is the disposal account entry, means if there is any asset that we sold. So here again the amount will come up is the cost value of the asset sold. Here's the most students do the mistake here. They write down the amount at which we sold the asset. So remember, we will not going to record the amount we sold for. Instead of that, we'll write down the amount we purchased for this asset. Means 2 years before or 3 years before, how much we purchased this asset for. So we'll write down the cost value here. So I'm going to write down here the cost value of asset sold. It will come up here. So only 3 transactions most of the times comes into this account. So we'll balance this account. This side will have a bigger value, so we'll transfer this side. So we'll get the closing balance with the balance CD on the credit side, and then it will become our balance brought down on the debit side. So that's the normal entries, that's the normal transaction that we'll have in this asset account. The next account that we can have in the question is provision for depreciation account. If you students have noticed that I did not talk anything about depreciation in this T account, so always remember, we're not going to do any calculations of depreciation while making asset account. So asset account means no depreciation, only the cost amount. So here in the next account, in the provision for depreciation account, we'll have an opening balance on credit side. So we'll write down here the balance brought down. This amount will be the depreciation amount of the previous years. Like if we will have any opening balance of provision for depreciation given in the question, so we'll write down here. So the next, after writing down this, I always tell my student to write down the disposal account entry first. So what we will write down here in this account, provision for depreciation account with the label of disposal, is the total depreciation of asset sold. So here the value is the value that is the value against the asset that we are selling, but the value is the depreciation value, not only the 1 year but the total life depreciation value. Like if we own this asset for 2 years, so we'll write down the 2 years depreciation. If we own this asset for 3 years, we'll write down the 3-year depreciation. So whatever the period that we owned this asset, so we'll write down the figure here. After writing down this, obviously we will calculate this the depreciation with the help of the method that will be given to us in the question, like straight line, reducing balance method, or the policy that we will have, like full year depreciation in the year of purchase, no depreciation in the year of sale. I will solve some questions for you to make your understanding better. How do we get this number? So the next transaction that we'll record in this T account is the current year depreciation, and we will mention this with income statement. So income statement, we'll write the number here is the current year depreciation. So this current year depreciation, obviously we are selling some of our asset, and we do have some of our asset right now with us. So the assets that we have mean the retained previous assets. Like we have assets of 100,000 and we sold only 10,000 of the assets, and we still have 90,000 of assets. So we will calculate the depreciation on 90,000 of assets, plus if we purchase any asset. So here comes, So we have three categories of assets here. The one we have previously owned means the old asset. The second one is the new asset that we purchased this year. Obviously, we own those assets right now, so we'll calculate the depreciation of those assets in this year. And plus, if we sold some asset, so that sold some asset may be used for some months, so we'll calculate this in this current year depreciation as well for that particular period, like for 3 months or 2 months or whatever months that we use for the selling asset. So here we have these three transactions only in this T account, so we'll add up this will have a bigger value, so we'll transfer this and we'll make this balance CD here, closing balance, and it will become our balance brought down here on the credit side. So these are the major transactions that we can have in this T account. The next thing, the last T account that we can have in the question is called disposal account. So in the disposal account, it's an easy account, so we'll have the double entry of the previously recorded disposal account entries. Like in the asset account, we have the first entry, disposal, on a credit side. So in this T account, we'll have it on the debit side. So we'll write down here the asset account, and we'll write down the amount, obviously the cost value of the asset, and then we'll have the provision for depreciation that was here on the debit side. If I'll show you right here, so that's the disposal account, so it will come up here on the credit side, provision for depreciation, and then here comes the bank entry right now. So this entry will be the amount of at which we sold this asset. So if we sold this asset for 6,000, so we'll write down the 6,000 here. So this will be the third transaction, and after that we'll balance this account. So if this side has a bigger value and this side has a smaller value, so we'll get the balance here, and this balance will be written with the income statement. So if we have a balance here on this side, it means it's a loss on disposal, so it will goes into the expenses section of income statement. So if somehow we have this side has a bigger value and this side has a smaller value, so we may have a balance come up here on the smaller side. So if the balance comes on this side, it will also mention with the income statement, but this time it will be your income, means profit on disposal, so that will goes to the the other income section in the income statement. So these are the three accounts that we'll have. So why do we make this disposal account? To know that if we make a profit on disposal or a loss on disposal. So the main account for this question is the provision for depreciation account. That's the most tricky one, so the students usually do mistakes while calculating the disposal account value of depreciation or the income statement value of depreciation. So I will solve some questions for you, so for the better understanding and to know how to calculate this disposal amount and the income statement value. So the easy account is the asset account. That's the first account that we have to make with the cost amount only, and the last account that we have to make is the disposal account to know the profit and the loss. So that's for this video. If there is any comments or anything or any question that you have, you can ask with the help of comment box. So thank you very much. I will make another video for you with the questions of depreciation. So thank you very much.